What are dividend stocks? Dividend investing has the potential to be a very profitable investment strategy. They have historically outperformed the S&P 500 while being less volatile. This is because dividend stocks provide two kinds of returns: regular income from dividend payments and capital appreciation from stock price appreciation. This total return can add up over time. Due to their low volatility, dividend stocks frequently attract investors looking for lower risk investments, particularly those in or nearing retirement. But on the other hand, dividend stocks can be risky if you need to know what to avoid. So watch it until the end and subscribe to Shareholder for more such uploads. Here we begin! Dividends are one-time or periodic payments from the industry's retained earnings to shareholders. These dividends are usually paid in the form of additional investment shares. Each share of stock, mutual fund, or ETF you own after the ex-dividend date will receive a dividend. Dividend-paying assets are appealing to investors for a variety of reasons. Some advantages include consistent income, asset appreciation, the potential of increased distribution over time, and tax advantages. Why consider dividend stocks? A great source of passive income. That organization, as we all know, consistently offers high dividend stocks and distributes profits to all shareholders. This provides them with a steady income comparable to the interest they would receive if they save money for a longer period. Similarly to how a bank guarantees returns on investments, dividend stocks guarantee returns to ensure that money is invested wisely. Less susceptible to market volatility. Investors who own dividend stocks do not have to devote time and energy to tracking stock or market movements. Dividend stocks are very strong and stable companies with fewer price swings and are less prone to market volatility. An investor needs a simple buy and hold strategy to start investing in dividend stocks. Less risky. Even if the market or a specific event declines in value, high dividend stocks retain their value. As a result, they have a lower risk profile than other growth stocks. The best thing about dividend stocks is that they regain their value during volatile market movements, making them a dependable option for risk investors seeking capital protection. As a result, the risk potential is effectively diversified when these stocks are added to a portfolio. How dividend stocks work? Consider the following scenario. Assume you buy 100 shares of a company for $10 each, with each share paying a 30-cent annual dividend. If you invested $1,000, you would almost certainly receive $30 in dividend payments over a year. That translates to a 3% yield, which isn't bad. What do you do with your dividends is entirely up to you. You can reinvest them to purchase additional company stocks, you can buy stock at a different corporation, save money, spend it, and so on with dividend stocks. Regardless of whether the company's stock price rises or falls, you will continue to receive dividend payments until the company stops paying them. The appeal of dividend-paying stocks is that they provide consistent quarterly payments as part of your return. Unfortunately, as the COVID-19 pandemic has shown, not all companies that offer dividend stocks can maintain a dividend payout in all economic environments. On the other hand, a well-diversified portfolio of dividend stocks can generate consistent income, rain or shine. When you combine dividends with capital appreciation as the value of the companies you own rises, your total returns can rival, if not exceed, the markets. How to build a dividend portfolio for 2022 and beyond. Mutual funds or ETFs versus individual stocks. Investing in stocks, mutual funds, or exchange-traded funds can help you diversify your dividend portfolios or ETFs. However, each has its own set of benefits and drawbacks. Individual stocks, for example, allow you to choose which companies to own and sell. You can also time your purchases so that you receive qualified dividends. Mutual funds and exchange-traded funds or ETFs offer immediate portfolio diversification as well as professional management that selects individual companies on your behalf. Furthermore, because these funds buy and sell stocks regularly, you may receive a combination of qualified and non-qualified dividends and short and long-term capital gains through no fault of your own. Retirement account versus taxable account. When you invest in dividends through a retirement account, you don't have to worry about the tax implications. When using a taxable brokerage account, try to time your purchases so that your dividends qualify. Long-term capital gains and qualified dividends are taxed at the same rates. Investing in dividend portfolio sectors. Some industries pay out larger dividends than others. For example, utilities, telecommunications, and consumer staples have historically provided the highest dividend yields. On the other hand, small company stocks and technology companies tend to reinvest their earnings to grow revenues. So many of these companies do not pay dividends. Or if they do, the average yield is significantly lower. Inflation's impact on your dividend portfolio. The impact of inflation is a major risk to be aware of as you build your dividend portfolio. Over time, inflation devalues your earnings and reduces your purchasing power. This is why selecting companies with a track record of increasing dividend distributions faster than inflation is critical. For example, if you have $100,000 in a dividend portfolio yielding 4%, you will receive $4,000 per year. However, goods and services will be 50% more expensive in 15 years if inflation remains at 3%. As a result, if your dividend payments keep up with inflation, your ability to pay your bills and enjoy your lifestyle may improve significantly. What are some of the best dividend investment strategies? The common misconception is that dividend stocks suit retirees and risk-adverse investors. That is not the case. Consider purchasing dividend-paying stocks when investing to reap long-term benefits. Dividend stocks, particularly those from companies that raise their dividends regularly, have historically outperformed the industry with lower volatility. As a result, dividend stocks are a good fit for various portfolios because they are aid in developing a diverse portfolio. There are various dividend strategies to consider. The initial step is to include a dividend portfolio in your overall portfolio. Remember that companies are not required to pay dividends in the same way that they must pay interest on bonds when constructing a dividend portfolio. The dividend may be jeopardized if a company's expenses must be reduced. The possibility of a dividend cut cannot be eliminated, but it can be mitigated. First, consider a company's ability to consistently increase its dividend rather than its dividend yield. Next, look for a company with a strong financial profile focusing on a growing industry. Another aspect of a dividend investing strategy is deciding how you want to reinvest your dividends. Some investors prefer to reinvest their dividends manually, while others use a dividend reinvestment plan or DRIP. Furthermore, this powerful device will reinvest every dividend you receive in that company's stock without any fees or commissions. This amazing set it and forget it tool is one of the most straightforward ways to harness the power of time and compounding value. Another dividend investing strategy is to purchase a dividend-focused exchange trade fund or ETF or mutual fund. Though these fund options, investors can own diversified portfolios of dividend stocks that generate passive income. Regardless of your dividend strategy, including dividend stocks in your dividend portfolio can be extremely beneficial. They will help reduce volatility and increase total returns, allowing you to achieve your financial objectives more quickly. Let us know your views in the comments section below. Also, remember to subscribe to Shareholder to never miss out on more videos like this.